I think my target would be that gold could be at 36,000 by 36. So in, let's say, in 10 years time, we could be like many times higher than where we are today, 20 times higher. Why? Because I think that we are moving into, as I said, the new inflationary environment. And I think we're going to see also that there'll be a lot of debt monetization and so on and so forth. But it still does not, again, there is a path to that. Yeah. And I'm not sure the path is just straight up from here. And if you look at gold, you'll actually see that gold is up 50% from the 2011 highs, but you'll see that silver is down like 45%. The platinum is down like 45 or 40%, and gold miners are down like 40%, 43% from those highs. So we have to wonder, why is it that gold is taking off and all the others are not?
Macroeconomist Henrik Zeberg has boldly predicted that gold could reach $36,000 per ounce within the next decade. This 20-fold increase from current prices is based on emerging inflationary trends and expected debt monetization. This aligns with the broader idea that a gold-backed monetary system could emerge if global powers, particularly the US and China, cooperate to address global challenges. Such cooperation could spark a long-term bull market in gold, pushing its price into the $25,000 to $36,000 range. Zeberg points out that since 2011, gold has risen by 50%, silver has fallen by 45%, and platinum and gold mining stocks have decreased by about 40 to 45%. The past decade's price movements provide essential context. After reaching nearly $2,000 per ounce in 2011, gold experienced a period of decline and consolidation before beginning a recovery in 2016. The metal achieved new milestones in subsequent years, breaking through $2,070 per ounce in 2017-2020 and recently setting a fresh record at $2,265 per ounce in April 2024. Meanwhile, silver has struggled to maintain momentum, with prices averaging $23.79 per ounce in 2013, representing a substantial decline from previous levels. Despite gold's impressive 30% rally in 2024, mining companies face ongoing challenges. The sector continues to grapple with inflationary pressures, particularly in labor costs, which have partially offset the benefits of higher gold prices. This dynamic illustrates the complex relationship between commodity prices and mining company profitability, suggesting that rising gold prices alone may not guarantee proportional gains for mining sector investments. Before diving into the video, subscribe to our channel and hit the bell icon so you never miss an update. Also, don't forget to share this with others who might find it helpful.
I think my target would be that gold could be at 36,000 by 36. So in, let's say, in 10 years time, we could be like many times higher than where we are today, 20 times higher. Yeah. Why? Because I think that we are moving into, as I said, the new inflationary environment. And I think we're going to see also that there'll be a lot of debt monetization and so on and so forth. But it still does not, again, there is a path to that. Yeah. And I'm not sure the path is just straight up from here. And if you look at gold, you'll actually see that gold is up 50% from the 2011 highs, but you'll see that silver is down like 45%. The platinum is down like 45 or 40%, and gold miners are down like 40%, 43% from those highs. So we have to wonder, why is it that gold is taking off and all the others are not? And is it because gold is bubbling? Because everybody talks of it? No. Or is it because that there really is something to it? I think it's bubbling at this point where people have been too fast and jumping in on this and the inflationary thing does not mean that, it's not right, because it is. But it does not mean that it's straight up from here. First of all, I've noticed also that central banks are not normally the best timers of buying gold. And obviously, we are moving into a more uncertain world. We're moving into a world now where debt is so big as it is. So I think it's good and fine. I hope the Danish Central Bank does the same. But I think it's not enough to withstand the kind of pressure we're going to see from a deflationary bust. If people are going to lose their jobs, if you're going to see a credit crunch, things will be sold off. Equities will be going to be sold off. Crypto, annihilated, and gold is going to be sold off. And I think you will see that. And I think and again, we also have to look into the fact that gold miners have not done so well. Why is it that we see the GDX, the GDXJ have not performed so fantastically as gold has done? There's a reason for that, I think, and then maybe it has to do with that it's really we're not in that cycle yet. For me, gold is actually, and I know this sounds crazy when you have a new all-time high, it's actually bouncing from a low. That's so I can show that on charts, and it's difficult to do here. But I think we're going to see that it's coming down rather strongly into that deflationary phase. And yeah, obviously there are buyers out there, but there will also be sellers. And again, credit crunch is not, and a Dixie at 120 will not be good for gold. So I think it's important to say that, even though gold can be a fantastic asset and will be, I think it is, and as I said, I'm a gold buck, and 36,000 on 1 ounce of gold in 10 years' time would not be surprising to me. And much higher levels for GDX and miners and so on. Fantastic opportunities ahead, I would say. Extremely fantastic. We are at, the bottoming end of all of this. But what we need to factor in is just what is happening the next 6-12 months from here. And if you can weather that and you can withstand that, then you will probably be able to have some of the best investment you can ever find out there. Because I think when the whole thing, I was not saying collapses, but when we need to have sound money coming back into the system, then I think gold will have a key factor in that. I think there's going to be a monetary reset. Gold will have a factor in that. And I think that is where you will also see gold starting to outperform, other assets it has, kind of struggled with, like Bitcoin. I think gold will be a better asset coming from, let's say, 25 into the 30s, 2030.
Henrik Zeberg compares the current economic situation to the 2007 and 2008 financial crisis, noting that both saw inflation fears before a deflationary bust. He suggests that similar patterns are emerging today, with recession concerns despite sharp declines in oil and copper prices. This reflects a broader economic backdrop similar to the Great Recession, during which the U.S. faced a severe economic downturn from December 2007 to June 2009, marked by a bear market that saw the S&P 500 lose nearly 50% of its value. Zeberg argues that weak demand for goods prevents higher inflation, as inflation typically results from rising production costs or strong consumer demand. Inflation is unlikely to rise without robust demand, leading to lower yields. This scenario mirrors the deflationary environment that followed the 2007 and 2008 financial crisis, where economic contraction led to falling prices and yields. Moreover, while inflation can burden the economy, some companies may benefit from higher prices if they pass on increased costs to consumers, reaping rewards from high demand for their goods. Let's get back to the interview.
But really, if you look at the short-term yields, you'll actually see that they have actually sort of dropped quite a lot. And they're dropping even faster now also in Germany. So the thing is, things are not looking great with that. The only thing we have had so far is September, October, and November, a spike in a bounce in yields, and the Fed will set the Fed rates accordingly. Right now, the Fed is so mistaken. They are way behind the curve when it comes to looking at the economy, and that has to do with the lacking leading indicators and the whole understanding of that. They look at inflation. Inflation is lagging the economy. So if you look at they were also talking about inflation and fear of inflation in December 2007, which was the month of the recession setting in, which was a huge deflationary bust. I mean, now again, the same. They talk about, the fear of recession at this point, when oil is about to roll over and has had actually quite a big drop. You see copper doing the same. And you see that, again, also coming back to Germany here, you'll have the ZEW was terrible numbers we saw here, and you haven't seen these low numbers. So the world is not a good place. Demand for things is not showing us that inflation is going to go up, and yields are going to come down. That's the way the world yields itself. Terribly late, and it's going to be, one of the key reasons we're going to see this crash is going to be even harder. I think they've gotten spooked by their own actions. They think that they let out the genie of the bottle in terms of inflation, and I think that is wrong because it's not just about the Fed; it's about the whole world, first of all. And second of all, what we had was a supply crisis in Corona, where we just put a lot of demand into the world. So everybody was stimulating the whole, every administration around the world was stimulating. When you have a supply shock and you then put demand on it, you get inflation. And now the Fed is spooked of that. So if you look at the inflation level that we have right now compared to what you saw back the month before we saw the onset of the 2007 recession, and also in the dot-com recession, inflation is now way below those levels we were at just a month before. And guess what? The job numbers are also. So that the Fed is doing this now is simply just a misunderstanding from their side, I have to say. You saw Yellen was out saying, we think it will be about 2.5% as a maximum, boom. No. And then it flew up to 9%. I mean, that just shows how little they understand what they're doing, honestly. I mean, it's shocking, actually. You would hope that there was some kind of an adult in the room, right? But somebody who says it's 2.5% as a maximum, it goes up to 9%, and now they say, we're afraid of the inflation, it's 2.4%. And they keep, pumping the brakes here. So when we start to see the momentum of the unemployment rate starting to move up rather fast, And we start to see, for instance, we got the yield spreads also, and we start to see the yield inversions. Then they should start to think, okay, maybe things are not as great as we think. But it seems like they are not paying attention to that at all. And I just have to say, they haven't, saved the economy ever. First of all, whenever my business cycle model has been suggesting we're going to have a recession, it has come every time, despite what the Fed is doing. The Fed was even standing in 2008 in February saying, "Oh, we're ready." In 2008, ready to act if we see a recession. Guess what? We were 3 months into the recession. So they haven't, honestly, no clue. We just have to see that. How many times do we need to see that they honestly have no clue? So I think we're heading in that direction, and unfortunately not so much we can do at this point here. They need to start following this in the next cycle. And right here now, it's about understanding that we are, heading towards the cliff.
Gold and silver remain essential safe haven assets amid economic uncertainty. While gold has grown significantly, silver shows strong potential for future gains, driven by inflation, geopolitical factors, and market shifts. Both metals are valuable hedges against instability and currency devaluation, making them key components in a diversified investment strategy. What are your thoughts on the future of gold and silver in today's economic climate? Let us know in the comments below. If you found this video insightful, don't forget to like, subscribe, and hit the bell icon for more updates. Thanks for watching.